that's where you start to see some of the stress. So let's break a few of those out. You mentioned cotton. That'd be one area that struggled. I think too about sorghum heavy areas that are heavy sorghum and wheat.
Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and it's a pleasure to have you on board with us as we look into different kinds of ag issues. Now, today, I want to welcome aboard Matt Clark. He is with Terrain, and I understand you work as how would you call it, a rural financial economist or something, or what is
Yeah,
your
rural
position?
economic analyst. Yeah.
Okay. So you watch things like land values and trends and that sort of thing. I saw where you had made a post a while back on social media and you were doing some comparisons to what's happening in the land market now compared to what it did, I believe, between 2009 and 2015. Is that correct?
That's correct. Yes.
Why that time frame? Why did you choose that?
Sure. So if you think about historic runs and land values over the last probably 20 to 30 years, we've had two really big ones. The first started kind of in that '08, '09, and it ran to about 2015. Now, during that period, we had a lot of different things going on. So you had a pretty subdued farm economy in the early 2000s, with some fairly negative years in there, 2002, for example. Then you had the renewable fuel boom, right? Had all the ethanol expansion. You also at the same time had probably the last great push from China and just, incredible demand for exports at the same period of time. You had a global drought that drove commodity prices to some extremes. You also had interest rates that were historically low for the first time in a really long time as the Fed dropped to zero following the great financial crisis. And frankly, we had several good years of farming. It was an elongated period of very, very good farm values. That started falling apart for various reasons. Commodity prices, of course, we had the really big fallout in cattle values. We had the fallout in corn prices and other things, which eventually led to some contraction in farmland values starting around generically 2015. Everything is slightly different from different areas, but we'll just call it that for now. Then we went through a period of poor farm income, right? And a period where interest rates started to rise a little bit, still historically low, but they started to rise. Then we had, of course, 2020 shock. Again, interest rates dropped. We also had, I would say, a flush of very positive government support to try to get us out of kind of the quagmire that was 2020. We'll just call it that. And a period resulting after that of strong farm income. And so farm values ran very strong. I'm not a believer that history always repeats, but sometimes it rhymes. And if you look at the shape of those two runs that I just described, they're very similar. And we're starting in some areas to see that flattening of land values now.
Where are we now compared to that cycle you referenced there between '09 and 15?
Yeah, so again, every area looks different. So I'm in South Central Kansas, for example. That's going to look different than if you're in South Dakota or Iowa or somewhere to that nature. So every area is a little bit different. But if you think about some of the general trends, we're kind of in that ninth inning, if you will, where still good quality land is rising in value or very strong in value, and some of that marginal ground is going down. So just for reference, maybe some places to look at. If you were to look at the Federal Reserve Bank of Kansas City, Chicago, and Minneapolis, they do very good quarterly surveys. So they would tell you that for the most part, land values up in that Dakotas, Minnesota area are still going up a little bit. Iowa maybe has flattened, declined. Parts of Kansas have very slightly declined, and Nebraska has declined a little bit as well. I would also say if you look at Farm Credit Services of America has a wonderful publication out there, January 25, that looks at state data as well. And they would also indicate places like Dakotas are doing well, whereas Iowa maybe has started to slip a little bit. Parts of Kansas and Nebraska have started to slip a little bit in values.
Now, what if the economy starts to fall apart as some fear? Some keep mentioning that we're on the precipice of recession, if not there already. Some have fear of maybe an economic depression or something. Do ag land values follow that? Do they lag that time frame?
Yeah, we're not short on headlines these days, are we? Yeah, and to your reference, obviously the first quarter of 2025 gross domestic product fell very slightly. They just revised it. It's negative 0.2% down. So obviously there's concerns going forward about what could this mean. I would say a few things. One, ag is not a tit for tat with the macro economy. Sometimes it can be a lagging indicator. Sometimes it can be a counter-cyclical indicator. And the reason for that is commodities, as all farmers know, are global. So sometimes they can move in opposite directions. And typically, when we have slower economic growth, we have lower interest rates. And in times where commodities are doing well and interest rates are low, farmers typically leverage and do well. So that's background. Let's address your question. Yeah, I think now for the most part, the macro side is probably less relevant to farmers. We've had several years of very good farm income. And frankly, if you're in the cattle sector, you're probably still feeling very good, specifically cow-calf. You're probably still feeling okay about things. So from that standpoint, there's some dry powder that I think even if the macro economy, I don't want to say, if it stays subdued, if it stays subdued for a longer period of time, I don't think that means an imminent collapse of land values. I really don't. I think farmers are in an okay-ish position where it's not going to help. What isn't helpful is that cash flows in the crop sector just don't look good. I mean, we can just be blunt. We need some continued price support there. And so, that puts a lid a little bit on how far out some of that dry powder can last. And I think it's why you're seeing those marginal farm ground prices decline, whereas that good value farm ground is still farmers still willing to pay up for it. So in the immediate future, I'm not worried about some sort of collapse in farmland values.
I have heard some analysts talking about the fact that maybe equities are getting kind of scary. If the bottom would fall out there, they seem to think that there might be a lot more value in capital assets like land. Maybe not so much just in home values because there are so many on the market, but land seems to be fairly stable. Usually it's hard to go wrong on that.
Yeah, you hear that a lot. At least the hard to go wrong. I always kind of chuckle at that one because inevitably I can just think of some farmers in my mind that would raise their hand on that historically. Here's what I would say, and I think it's a great point. If you think about farmland in general, and let's just talk Midwest now, because California's got its own issues with water and a very different structure, or I'd just say the western area of the U.S. So let's just talk Midwest for a moment. What we've seen over the last, I would say probably 15 plus years, is that, to your point, investors in a broad sense, and I don't just mean an individual willing to buy a quarter of land here or there. I mean people who are willing to flow significant money into agriculture, have viewed land as an asset comparable to other equities and other assets, such as you mentioned, whether that's commercial real estate, home real estate, any of those kind of things, and have done very well in it for the most part. As a result, you've got a new class of investors that are going to look at returns very differently than we think about them in farming. And they're going to look at flows from a macro standpoint very different than we think about it here in rural South Central Kansas, for example. And that does mean that in times where equities maybe or treasuries, for example, are maybe less certain, that you could see flows into ag land from those classes. Now they've got models. There's a lot of factors that play into that they're broader than I could speak to in a generic sense, but it is a possibility you continue to see that class of investors certainly stay in on the good quality ground or reach on some other things, depending on how the macro side goes.
Is it getting harder to qualify to buy land now, especially if you're a younger farmer?
Yeah, I'm in that camp. I don't know if I'm younger or not. I don't know. I hope so. Well, here's what I would say. You've got a couple different factors going on that for the younger individual make this scenario a little bit more difficult than prior years. So one, interest rates have risen quite a bit. So I mentioned last cycle, you think about that, we'll just say '09 to 14 period, you had the Federal Reserve at zero interest rates, and you had a prolonged period of interest rates very low. Okay. Now, as the Federal Reserve has raised interest rates, as Treasury markets recently have gone up, you've got a period where long-term interest rates, particularly if you're looking for a long-term fixed rate, have significantly increased, comparatively speaking, to that last great run. So if you are a younger farmer with less equity and you are tighter on your cash flow just because you're trying to get going, the compounded effect of those two, along with a really large run in interest rates and a really large run in land values, makes that cash flow situation much tighter. So, again, we could pick different times in history that look similar to this or maybe different than this and kind of compare and contrast. But yeah, generically speaking, it is difficult for that younger group to jump in, and probably always has been, but there's some unique factors now that have maybe exacerbated that issue a little bit.
Well, up until last year, um, grain farmers, for example, had some really good years. I mean, for profitability, they were able to build up a nest egg. Are you seeing a tendency for older farmers to cash in their chips right now instead of trying to farm until they're 90?
I chuckle at that one because it's an ag that's such a unique thing comparatively to other industries. And a large part of that too, just backing up to kind of cover the basis of your question, if you think about the run in equipment, um, and the ability of technology over the years to allow individuals to farm longer and healthier, kind of has prolonged that typical runway or that typical off ramp for the farmer, meaning technology, and specifically I'm thinking tractors, combine sprayers, really allows a farmer to farm longer than they did previous decades, for example. Because of that, you do have a strain in the terms of when do people get off and when do people move up in their asset purchases, just to kind of tie it. In some ways, yes, I think we could find little points here and there of say, yeah, there's individuals that are backing out a little bit, whether they're cash renting or outright selling, or they're selling equipment, holding on to land and crop sharing it, or whatever that looks like. You could probably point to some instances of that. I wrote an article, is about 6 or 7 months ago, out on Train Ag's website, that looked at life expectancy, not age, but life expectancy of farmers over time. And what you're noticing is it's the gap is narrowed, meaning farmer age has increased, but it's increased faster than life expectancy, meaning yes, we've always had this conversation about there's always older farmers out there. There's some that are going to go, retire and live out the rest of their life, which we hope they all do. But that gap is narrowed a little bit in terms of age versus expectancy. So I do think you see a pressure for some of those individuals to move out. And I think that's going to be ongoing and probably, to your point, increasing here as cash flows are a little bit tighter now compared to when they were.
So I would imagine this is a really regional situation. For example, like last year, the market fell apart for cotton. Makes me wonder what is happening in land values in the South versus I've heard some land value increases in places like maybe Iowa or Illinois, where they grow
Mm-hmm.
different crops and that sort of thing. How much of a disparity is there between different areas where you live? You mentioned California before too.
Let's break out a few of these. So a few different factors to consider. So if you were to think about areas that are heavy cow-calf, who have had a really long run of quality land values, I think those areas are still doing very well. So I mentioned South Dakota, both Farm Credit Services of America and the Federal Reserve Bank of Minnesota shows South Dakota land values doing well. Kansas City Fed shows areas like Oklahoma and their Mountain State region still holding very well. That would be evidences of, to your point, regional income still being okay. Likewise, Iowa's always feels like a bit of a bellwether, right? Kind of how Iowa goes, your corn belt and kind of corn rim goes as well. Again, if you were to go out to the Chicago Fed site, they would say their land values are flat. As I talk to lenders at Farm Credit Services America, they would say, well, flat, yes, but the good areas are still doing, to your point, very well. And some of the marginal areas are doing less well, so the average may be flat, overall still good. Comparatively, if you go to areas that have struggled and had maybe several years of poor income, that's where you start to see some of the stress. So let's break a few of those out. You mentioned cotton. That'd be one area that struggled. I think too about sorghum heavy areas, areas that are heavy sorghum and wheat, but maybe don't have the cattle income. That would be another area where you start to see some of that stress. So maybe that's parts of central Kansas that don't fit the cow-calf sector. They don't fit the corn soybean sector. They're that milo and they're that wheat area. They've struggled a little bit more. Then you move out to areas that have really struggled. So you think about areas that are heavy into almonds, for example, which have had a very difficult run. Maybe some of the wine grape areas. You can go out to Terrain Ag's got a great, it's called Winescape, where they really go through some of the wine grapes. Those areas are also being impacted by heavy water restrictions. So those areas, land values have struggled more as well. So again, to your point, regional, a lot of different factors in there. You kind of got to piece and parse it out.
So I guess to wrap this all up, compared to maybe a decade or so ago, all things considered, land values are actually doing pretty well, aren't they?
Yeah, it's easy to talk about year over year changes, but if you think about how a farmer experiences this, it's the compounding effect, right? And we've had really, really good run in land values over the last 4 or 5 years. Had some decent cash flows to kind of support that along the way here recently, obviously changing a little bit, regional by regional. So I don't put me in the category of people that are thinking there's some sort of giant collapse. I'm not in that category at all, and I understand the stress and concern around that. I don't think we're in that scenario right now.
Well, I appreciate you joining us and sharing your insight. Very interesting stuff that you talked about there. And it'll be really something to watch this year. Who knows? We may have a weather event creep in yet, and nobody knows how this season will turn out. But I appreciate the update and hope to talk to you again soon. All right.
Thank you, Marlin.
All right. Matt Clark with Terrain joining us today with a look at land values and how they're holding up so far this year. Appreciate you joining us. For producer Breanne Jenkins, I'm Marlin Bohling. We'll catch you next time here on the Comstock Channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.